All right. I think we are live. So welcome everyone. I see a lot of people popping on here. So we'll probably give it a couple minutes just to allow everyone to join in. We can say hello to our wealth advisors. DJ, how are you?
Hello,
Where are you zooming in from?
I am in our Eugene office, down south.
All right. Jason, how about you?
I'm in our Corvallis office.
Excellent. Chandran, it looks like you are far away.
Yeah, I'm in Sri Lanka. Sorry, guys. I need to quarantine in the nicest spot. Actually, that's a picture of Sri Lankan beach. I was there last year. Yeah, that's where I was born. Came over when I was 9, so it's a great spot.
Yes, it is.
But I'm in Salem, in our Salem home office.
Nice. And Matt, how about you?
Hi, I am working from home, so far so good.
All right. So as you can see, we're all working from our different remote locations, but our business is still open, and we are an essential business, so that is good. So we have everything is working on our business continuity plan, so that's good news. Okay, let's give it a couple more minutes here.
And I'd like to say I actually am in a full suit, all the way down to the shoes. I'm not wearing pajama bottoms, all right?
I'm sorry, why do you need to say that? Was there another option?
What are you doing, Chandran?
I can't tell below my waist. No. I'm in a full suit too.
Hopefully there'll be no fire drill.
Yeah.
I've seen some pretty funny pictures online.
Yeah.
All right, well, thanks everyone for joining us. We have a lot to talk about today. And as I'm sure we're all aware, you know, we are living in a different world compared to 6 or 7 short weeks ago. And we had a lineup of spring seminars set up for all of our locations that we are in Oregon and Southwest Washington. And we had to kind of course correct and turn those into webinars. So this is the first of a series of webinars that we will do over the coming weeks. You can find out more details about upcoming seminars on our website, financialfreedomwmg.com, and we would love to have you join in on those as well. So today we are going to talk about the markets, what's happening in the markets. We're going to talk about our investment strategy and our investment philosophy, and you're going to hear a little bit from each one of us as we work through these challenging times. So first we'll talk about if we have clients on this call, as well as people that aren't working with us yet. So we are going to introduce who we are. We are also going to, like I said, to give the market updates and our strategy. And then also I will finish up at the end and give you some next steps and maybe some opportunities to think about during these times. I think there's challenges, but there's also important to see the opportunities that we all have as well. So first up is Chandran. Chandran is our president and also a wealth advisor. He tells me of all of his career that this is his favorite career yet. And I think it's because he gets to work one-on-one with those clients and really make an impact.
Right.
Yeah, so Chandran came to us in late 2012, early 2013. And it was a amazing partnership. He brought a lot of executive experience. He has worked, as you can see here on his resume, with big Fortune 500 companies, Dell Computer, IBM. He was also the CEO of SoftChoice and Gessettner, and has just a wealth of wisdom that he brings to our team. And a lot of the growth that we have experienced over the last 5 years is the principles that he's instilled within our company. He is also the author of Catch the Arrows, a book you will find on Amazon, so go check that out. And he is also has all the licenses, and that is our licenses. All of our licenses are held with LPL Financial. That is our broker dealer who we work with. So Chandran, take it away.
Thank you, Julia. Well, it's my pleasure to also tell you a little bit about Julia, our founder and wealth advisor. Julia started this business over 20 years ago. We're in year 21 right now. She's an investment advisor representative and registered principal with LPL. She's got all her licenses, etc. And you can see her family there on the right side. Not only does she run a company and do amazing things in the marketplace, she also helps raise 3 kids. So that, you've got quite a full plate there, Julia. If you take a look at some of her recognitions, and we only have a few listed here because of the interest of time. We don't want to spend the whole webinar on that, but top women wealth advisor in 18 and 19, top wealth advisor by Working Mother magazine. You know, in 2016, she became the Smart Investor Pro for Dave Ramsey, which we all support. Back actually in 2008, the previous one called ELP, Endorsed Local Provider, is when we became that. She was a top 40 under 40 financial advisor. She can't win that anymore. I don't know why. Well, let's see. That was a couple of years ago. You can see there she has a column in Newport News Times. And in 2018, 19, and 20, the Financial Freedom, Julia and Financial Freedom voted Forbes Best in State Wealth Advisor in the top tier. So Julia brings amazing recognitions to the table. Julia, actually, she and I met over 18 years ago when we first started our relationship. So it's been wonderful. Yes, and this is the best job I've ever had. That includes that CEO role that you talked about.
Thank you, Chandran.
Okay, so a little bit about our company, Financial Freedom, founded in 2000. As I say, this is our 21st year in operation. And I think the key word on this chart is that we're an independent wealth management firm. So we work for our clients, not for some other large organization, and provide customized planning solutions to those people. So individuals, families, businesses, and executives as well. Now, one of the things that I often, if you're of the clients listening, you've heard me say many times, there are 212,000 wealth advisors in the United States. Probably half of them can do almost as good a job as we do with clients' funds and investments. But what's unique about us is that we run with a set of core values that we would never violate. And you can see it there: treat all people with respect, never compromise their integrity, delight our clients. You know, at one time we had in a previous company, had some young people say, you know, we should use more modern terms like wow, our clients. But I said, no, delight it's got that tinge of excellence that we adhere to. And our whole team follows that whole process of delighting our clients. And speaking of team, we embrace our team culture, meaning one of the things about our whole company is that we're one team. Everybody works as one team. Our clients know that they can call and talk to anybody and get the service and the answers that they need. Because as a total, our commitment is to care deeply about our clients and their financial life. And I think that differentiates us from everybody else. And it actually makes our job so much more enjoyable and rewarding for us because we know that's what we're doing. We're in the money business because you're good at it, but this is really what our goal is. And our focus is to create a plan for your dreams and inspire you to pursue financial freedom, which is a catchy phrase, right? Financial freedom. I like that. So, now, we serve our customers out of 5 locations. Our 2 main locations are Newport, the large building on the bottom there, and Salem. And we collect, our people typically collect from there, but we go to meet our customers in Vancouver, Corvallis, and Eugene. 13 of us, 5 wealth advisors. And as Julia mentioned, supported by LPL Financial. We'll talk a little bit later, but LPL is the largest independent broker-dealer in the country. Back to that importance of independence where we're working for the clients, not for some large organization. There's our team. We're all smiling at once for a change. That's all 13 of us, and we're proud to be able to serve you, our clients, and our future clients with that. Our wealth advisors, you've got the 5 of us dressed up in our Sunday best. Actually, that's my same suit I'm wearing today. And if we can move on to the next slide. So our comprehensive wealth management process is that not only are we your steward of your funds and your investment, but we want to make sure that we help you reduce taxes. You know, there's no reason to pay 1 penny more than you have to, and we'll make sure that happens. When you get to the point of retiring, you know, as I say to people, you usually can't make it again. You know, you're retired, you built your nest egg. How that plays out for your income and distribution for the rest of your life is critical. And that's what we focus on to make sure that lasts to not only the rest of your life, but if you have a legacy requirement, if you have family, and if you want to pass that on, that it passes to them and not to the IRS. And if you own a business, the whole idea of getting ready so that you can maximize the valuation when you exit that business is another part of our services. Let me introduce to you this our executive team. As Julia mentioned, I'm the president, she's the founder, but today we have Jason Harris, our vice president. Jason has, he's a good looking fellow. Speaking of good looking, look at his family, the gorgeous family. I guess in Disneyland in better times when it's okay to be close together, right? Although I notice you're at least 6 feet away from everybody else.
Hey, who pulled that picture off of Facebook?
Yeah.
I don't know.
I'm glad you covered your head so they wouldn't get sunburned. But he's a certified financial planner. He's got over 14 years experience with systems. In 2012, he became the Ramsey Solutions Master Financial Coach. And so he adds that value to our organization, to our clients. Great business experience, HP, Portland, Oregon. And he's an active volunteer in Corvallis, Oregon. So, and if you ever wanted to go and look for parks in Corvallis, you'll see a video of his family, of his beautiful family there as well. He's also got all the normal investment advisor representatives, Series 7, et cetera. I think one of the key things that everybody should know, our clients know, is that all of our wealth advisors are fiduciaries at the top level of licensing in the marketplace. Okay. So I'm going to turn it over to Jason, who will tell us about what's happening in the market. Jason, what's happening to our 401k?
Good question. Hey, before we do that, though, I do want to give acknowledgement to our newest wealth advisor, Matt, who's on the call here. Matt, do you got a couple words for us before we kick into these market updates?
Yeah, thanks for putting on these webinars. I think they're great, and hopefully everybody finds them as informative as I will. So appreciate you guys doing that for everyone.
Yeah, so we're glad to have Matt on board. He's been with us for a little over 6 months now, I guess closer to 9 months now. So glad to have him serving mostly our Newport clients, but any clients that need help. So welcome aboard, Matt.
Glad to be
Oh,
here. Thank you.
all right. So for these market updates, our first slide, which we did before all this happened, shows, are we headed for a recession? The answer is yes. A full and resounding yes. In fact, we're already there. So some of the things we want to do today in terms of market updates is talk a little bit about what has happened or what we've seen in the past through recessions, and hopefully that will give you hope for the future, knowing that it's not as bleak as the news media makes it out to be. So we're gonna go through that. So here's a little bit of history, market ups and downs. Just looking at the S&P 500, those are our largest US companies, and that's an index that you can look at. But if you see these red downs, this is using a 20% threshold, there's not really that many of them from 1926 to last year. Of course, we need to add one for this year. But look at that, there's about 8 or 9 that have those big downs. And then you've got the big ups in between. Now, if you look at some of the ups closely, you can see there's still dips in there, but that 20% down is not as common as we would think. Funny thing is that so the first quarter of this year, I guess it's not really funny because it was the worst quarter on record, being a full 20% drop. And March was actually the most volatile month ever recorded. So these are kind of uncommon times and really unprecedented. But what we're seeing is that it's been a very quick recession. So we got there very quick, which is not normal. And the most likely outcome, even based on what we're seeing with the coronavirus, with deaths starting to slow, with cases starting to slow, it will likely be a quick recovery as well, from what we've seen. Okay, and then this chart shows a little bit of, looking at the significance of declines year by year from 1980, so the past 20 years here. You can see there were some pretty big dips. Like if we look at 2008, of course we all remember that. Throughout the year, there was a drop of 49%, but that's not where the market ended up for the year. Still down 38, but good thing it didn't lock in at 49%. And in fact, if you look at every year, the drops were a lot more significant than where the year ended up. We had a 35% drop, so that's been the largest to date. If you look at some of these 30s and 28s, you can see that the end of the year is better, and quite a few of them were positive. So could it be that, especially if we have a sharp decline like that, that the rebound and the outcome for the year could be higher, and maybe even positive numbers? So those are just considerations to look at, that even though it drops so significantly, we don't set that up as, okay, it's going to be terrible and we're going to stay at a 30% loss. No, things do rebound and grow. And even from what we've seen in the market starting to price some of these things back in, Monday saw one of the biggest ups we've seen in a long time. So very volatile, but still growing. Okay, looking back at past recessions, this chart shows about 8 of them. And now current, it says current there. That was before, like right as the year started, that's what we were looking at. So there were no true signs of a recession. There were a few indicators that things were slowing down, but look at the consumer section. Housing permits were up, jobless claims were good, retail sales were good, job sentiment was good. Of course, all those would be red X's now. But coming into this recession, this is why it's uncommon, is things were good. And so the US economy is most likely to rebound fairly quickly because people are just waiting for things to open back up, for people to be healthy again. And so we should see things rebound fairly quickly from here. So again, deep recession, but hopefully a short recession. Okay, now let's look at how portfolios do in response to a crisis. We've got 7 different crises that have happened over the past many years. A lot of our clients remember the October of '87 stock market crash, pretty significant. Had a few clients discuss that. A year after the crisis, now mind you, this is in a balanced portfolio, so someone who's got about half stocks, half bonds. These are for people that are either taking money from retirement or approaching retirement. But a year later, after that stock market crash, 19% gain in that portfolio. That's pretty good. Then 3 years later, you're looking at an average of 11% per year, which is great. And then 5 years later, you're looking at an average of 15%. That's the big 76 number there. So 15% per year after the stock market crash of '87, that's pretty good. Then let's also look at 2008. We all remember that, right? And then that was the bankruptcy of Lehman Brothers. 4% return after that first year. And on average, 5 years later, you're looking at 9.4% per year being in this kind of a balanced portfolio. And even the terrorist attacks, look at that. Of course, the first year was still negative, but 3 years later, I mean, 81% total return over those 5 years. So that's why we don't panic and freak out when things are happening in the market. If we've got things set up for you to last through this recession, you're going to come out of the other side better than where you're at today. And so now is not the time to abandon the plan. Let's just throw everything out since we can't leave our homes. We're just done with this thing. Not a good time to do that. This is the time to stick with the plan that we set up for you, or if you have an advisor that's set that up for you, you do want to stay the course, because those that jump off on the roller coaster going down, they get injured because it can go really fast, especially in these volatile times. And it's certainly not a time to be timing the market to try to figure out, you know, do I hop in now? Do I, you know, just stay your course. On this slide, this is showing very eye-opening. So from 1926 to last year, after a market decline of 10% or more, here's how these 1, 3, and 5 year periods look. So a year after, on average, of a decline of 10% or more, a year after, your large US companies are doing 11%. 3 years, you can see it's 10, and 5 years, you're at 9.6 per year on average for those 5 years. So to hop out of stocks when things are low, you could miss some of these upswings, and you could really ruin your portfolio. So we don't want you to do that. For your long-term money, you stay the course, you stay invested. Then on this last slide that I'll cover, our emotions can really play into our decisions. In the bottom of this chart here, you can see fear. I'm sure if you weren't there, you probably, well, most of us were there. Like, what's gonna happen? Is this ever gonna recover? We've never seen drops like this in our lifetime. And a lot of fear can set in. That's not the time to make course corrections unless there's something other that's going on in your life. But we are really looking forward to the optimism side. And as you can see, it's cyclical. So this just keeps going. Optimism is the next thing. And if you look at what the Fed is doing to infuse capital into consumers as well as into businesses, I mean, this is the largest investment that's been made to date, $2.3 trillion. Pretty huge infusion. What the Fed's done to cut rates, what that's doing is helping kind of just reopen the economy and as soon as we're able, hopefully in the next 1 to 2 weeks, that's, fingers are all crossed that we can start to open things back up. And really that optimism, you can already start to see it in the markets, but eventually it will come to all of us. It's also there's a indicator called the VIX, and that measures volatility. You're also starting to see that kind of settle. So that means a lot of the fears are being washed out, and then we're going to go into this optimism. So that's the encouragement, is to, as we've set your portfolio up to weather these sorts of storms, we've got conservative money that needs to be conservative, long-term money that needs to ride these things, because long-term you're going to win when you're invested, when you stay the course, and when your stocks are actually growing for you and not going the other way. All right, with that, and if you do have any questions, I know that there was a lot that we're covering, you can put it in the question and answer box. We're going to be going through those. We may not get to all of them, but we'll do some of it throughout the month on Facebook, and then we also may bring some of those into our next part of this series as well. So with that, I'm going to bring up DJ to talk about our investment strategy, and a little bit about DJ. There he is, one of our phenomenal wealth advisors. He did come from that University of Oregon school. We are rivals, by the way. I went to Oregon State, thank you very much. But glad to have our Eugene native here with us. He's got his 4-year-old son. Now, he's not 4 in that picture. I don't know if he can even hold him anymore, but
He needs a haircut in that picture. Where is his dad? Come on.
Another one. We just pull these things off of Facebook. It's amazing. So anyway, DJ is really best suited to talk about our investment strategy. He's key in all that we're doing to build our portfolios. And so I will turn it over to you, DJ, to take us away.
Thank you, Jason. So we're going to start with some basics and then transition into our specific strategy here at Financial Freedom. So why do we invest our money? Well, to build wealth, right? To reach our financial goals, attain financial freedom, but at the very least to outpace inflation. So inflation is the increase in prices over time all around us. So historically, this has been at 3% per year, which means prices are doubling every 24 years. So if you aren't making 3% on your money, you're actually falling behind, right? You can buy less with those dollars each year. This is why we recommend you keep your 3 to 6 months of living expenses in the bank and have every other dollar working for you somewhere. So the two main investments are stocks and bonds. Now, stocks represent ownership in a company, whereas a bond represents a loan made to a company or the government. So let's use Nike as an example. So if they wanted to raise money, say to build a new warehouse in Beaverton, they can issue new shares of stocks or bonds. Those would be two of their options. So to issue stock means that they're selling a piece of their company to the public. So if you buy their stock, you are now a partial owner of Nike. Maybe one shoelace, maybe two, depending on how many shares you bought. But there's real value there, right? You are a partial owner of that company. So if Nike wants to raise money, but they want to retain all their ownership, right? They don't want to sell a portion of their company off, they can issue bonds. So this is a loan from the public, and then they pay you back over time with interest. So the government also issues bonds to raise money for various projects that they want to do. Now, these tend to be safer than corporate bonds because of their ability to tax. Now, because they're safer, they don't pay you as much, right? That's that risk-reward relationship. So we generally invest in stocks and bonds through mutual funds and exchange-traded funds, or ETFs. So these are both pooled investments that allow investors to basically come in and buy a piece of that fund. So they'll buy a bunch of different stocks and bonds. They have that pool, and investors can get a slice of the pie. The main difference between mutual funds and ETFs is that mutual funds trade once at the end of the day, right? The fund manager will collect all the orders and place them in at the end of the day, whereas an ETF trades throughout the day like a stock, right? You actually are selling it just to another investor that wants to buy that ETF share. So the modern day mutual fund was invented back in the 20s. So at that time, a share of GE stock was a couple $100s. What's amazing is the average household income was around $3,000. So most people, most families couldn't part, right, with 200 bucks to go buy one share of GE. So investing was really for the wealthy out there. Now the mutual fund coming into existence changed this, right? Now you could come in and buy, $1 of some mutual fund. So it really opened the doors for investing to everybody. And today, most investments are done through some type of fund. So if you want to go ahead and go to the next one there, Julia. So the thing about retirement money, and Chandran mentioned this, is you can't make it again, right? You got to protect that. And so we help you do just that. We help you protect your money, but keeping it growing so that it lasts a lifetime, right? We're living longer and longer lives. So you got to be able to draw off of that for potentially 30, 40, 50 years. And then a lot of people also like to leave something for their beneficiaries. So we're long-term investors here. We've found that trying to time the markets does not work, right? There's a lot of this happening right now, tons of it. People think they can predict what's going to happen, and it usually doesn't work out in their favor. By moving in and out of the market, basically you risk missing that recovery. Jason was talking about that too. When it does happen, it's usually pretty aggressive. And so you need to be in the market there so that you can participate in that. If you try to time it, pull your funds out, things move back up and you could miss it. And so that's why, you want to have a plan and stay the course, especially when things get tough like this. And then we reduce risk with a well-diversified set of investments. So we generally invest in the top 80% of the market and avoid individual stocks. So when you're investing in individual stocks, you're taking on a lot of risk, right? You're banking on that company specifically. Let's go back to 2008 with GM and Enron. Two examples of huge companies where they filed bankruptcy. GM did survive, but if you owned their stocks, you lost. Right? And so that's a risk that we don't think we should be taking. And so we reduce that by, again, investing in thousands and thousands of companies all over the world. And lastly, we let the markets work for you. So companies come and go, but markets survive, right? The S&P 500 has totally new set of companies than it did when it first came to be, right? But if you invest in the S&P 500, it's still here. So that's why we try to avoid trying to pick those winners. Very risky. And then, the stock market, it doesn't just survive, it's averaged almost 10% per year since 1926. So it does really well. So here's a graph of the US market. You can see the Great Depression right off the bat there, pretty extreme drop. And then the Great Recession, that's kind of near that right side. Obviously, new charts are going to show what we're currently going through. So that first line, the blue line at the top, that's the growth of small companies in the US. So they've actually done the best over this time period. Then you got large companies, then you get into government bonds for those next two lines, and then you have the inflation line. So that's increase in prices. So stocks, those are the top two lines. This is what keeps your money growing. The issue with these is lots of ups and downs in the short term. This is called volatility. And you can see how choppy those two lines are, right? Those next bond lines, that's the green and the light blue. You're giving up some of that return for the stability, right? You can see how smooth those lines are, but $1 turns into $20,000 for small companies versus $142 for government bonds. So, again, it's a smoother ride, but you aren't going to make as much over the long term. Go ahead and go to the next slide there, Julia. So when we're deciding how to invest your account, it's really all about you and your income needs. So we use what we like to call the bucket strategy. This is a great, I actually visualize this in all the accounts. So imagine you've got an aggressive bucket and a conservative bucket in your account. The aggressive bucket is made up of stocks, keeps the account growing, as you saw on that last slide. Whereas the conservative bucket is made up of your bonds. And this is like your safety net, right? We generally stock that conservative bucket with about 3 to 5 years of your income needs so that we can draw from that during bear markets. You can actually go back. Yeah, let's go out a little more. Thanks, Julia. So again, you have 3 to 5 years in that conservative bucket so that when we go through bear markets like we're going through right now, your aggressive bucket is temporarily down, right? Now, we're not going to sell that. It's going to come back. Markets are resilient. We're going to sell that conservative bucket to ensure that we're not selling on a low. When we get back out of this, whether it's in 6 months, a year, we will refill that conservative bucket and get you ready for the next bear market, because we will go through another one at some point. And we can also tailor this based on your risk reward level. So I told you we usually do 3 to 5 years in that conservative bucket, but you may be a more conservative investor, right? You have to be the one that's sleeping at night. So if you may be okay with, why don't we have 7 years of income needs in that conservative bucket? I'm okay giving up some of the return over the long term for a more smooth ride along the way. And that's fine. So by using the buckets, right, investing with a long-term perspective, not trying to time the market, staying the course, and being well diversified, you're always ready for market changes like we're going through right now. Because that's the thing, based on history, we know this is going to happen. We just don't know when. And so that's why we want to always be ready. So when we're designing our investment portfolios, we're looking for investments with great long-term track records, right? We want to see some history there. Always looking for low-cost funds. And probably one of the biggest ones is it in alignment with our investment strategy, right? We wouldn't use a fund that's taking on a whole bunch of risk to try to make the most money in 2-3 years, right? That doesn't fit for us. It's got to be long-term type of fund. So also during bear markets like we're in right now, we're always looking for good opportunities. Julia was talking about that, how yes, it's tough to go through, but it opens the door. It's a once in a decade opportunity for a lot of things. And so we're looking for investment changes or other things that we can capitalize on and really boost our clients' accounts. So we have made some changes for some people, and I know Julia is going to talk a little bit about some other options to think about. And it's very case by case specific, right? It has to be right for you and your situation. And then as far as our investments, right, we're watching this stuff for you guys every day. We love this. We love what we do. And then all of the 5 of us advising team, we get together each quarter at minimum, usually more than once a quarter, and we will talk about all of our investments and look at other opportunities and make a decision if we want to make any changes. And again, it's a collective, right? We're a true team. Everybody's view is important. So I'll go ahead and send it back to you, Julia.
Okay, I'm thinking let's pause there. There were a couple questions about the markets and timing. Maybe I'll even go to the previous slide here. So some of the comments or questions that we were getting is, if we knew historically that during like big health issues, whether it be in China or SARS or previous impacts, why wouldn't the accounts be adjusted accordingly to mitigate some of the downturn, or better off, reinvest after a period of time near the bottom? This is a really tricky question, and we get this all the time. So I think some of us can chime in on here. I know we don't have a crystal ball, but there seems to be evidence that the markets were at risk. So let's start with that one. I would say, let me start with my opinion, and then you guys can chime in as well. But I would say We were in a 11-year bull market going into this downturn. And there were about 18 months ago for our clients that were in retirement, so taking income, needing that conservative bucket, we actually shifted some to a more tactical manager. So what that means is someone that does look at these on a day-to-day basis on the global investments and shifts to where there is the least amount of risk with and the most amount of upside. And so within that piece of our portfolios that we shifted 18 months ago, that did protect our retirement portfolios more, so like cushioned the blow, if you will. Because the other thing about this question is, what if the bottom's already happened? Jason talked about the markets overall were down about 35%. Now they are down less than 20%. So we never know when the bottom is until we get past this and look back. The market is a very forward-looking machine, if you will, meaning the market is factoring in things 9 months to a year in advance. So why on Monday, when this is the worst week in New York, people are dying, there's records that the market is up 1,600 plus points? It's because the market again is forward looking. They're saying, oh my goodness, could this be a peak? That would be good news for the market down the road. That means we're going to be on the other side of this. We don't get to know what the bottom is. Will we go back and test the lows again? Possibly. There's a good chance on that, but we can't know when the bottom is to get back in. So if you go to cash and wait for it to come back, then you'll miss all of those good days. And those are the days that you need that make the difference to bring those accounts back up. Anyone want to add?
With that, Julie, I pulled a report of if you missed the 10 best days in the past 10 years. So from 2009 to 2019, if you miss those 10 best days in the S&P 500, you lost 4.43% per year on average.
Yeah.
So almost 5% per year was taken from your gains. And that's partly why we plan, is so that we don't have to do these kind of timing and guessing games, because generally those that do a lot of shifts and guessing, they end up losing because they invest based on emotion, like we were talking about. When things are low and you're fearful, that's when you want to make a shift to more conservative, but it's actually the opposite. That's when we should shift to buying, and then obviously sell when we're feeling really happy. That's the time to kind of shift some of the gain into things that have not gained as much.
Exactly.
Right. And you've got to get it right twice, right? You got to know when to get out and then know when to get back in. Or you could just stay the course and know that this is temporary. My account's set up for this. I'm going to be way past this. And also and it's easy to look back. Now we know that this was a pretty significant thing, right? 2020 hindsight. But in the last 10 years, there's probably been a number I can think of, government shutdowns, things like that, where people start to get freaked out, but it's just short-lived. And so if you said, okay, this is going to be another event, I'm going to go ahead and go to cash, and then it was a month-long deal and we're way past it. So that's where you just want to stay the course, because you just don't know.
Mm-hmm.
Right. Current one is in December of 2018. If you recall, we had a sharp drop, and if people had gotten out of the market, it was very short, because you would have missed all of 2019's gains, which is like 19 to 24%, depending on what you were invested in. So you would have lost. And I remember an article that I read in the Toronto Globe and Mail business section. They did a study over 15 years about average investor and how much they made. And they had made about 3% per year. Yet the mutual funds they invested in made 8% per year. And the difference was that these average investor got euphoric when it was going up and bought more, and panicked when it was going down and sold. And so that alone meant that they, as Jason said, lost a huge amount of their potential gain.
Yeah. Okay, so let's answer this other question is shifting funds among multiple accounts inside, this is a retirement plan that they have at work. And is that, so if they were shifting funds within that, considered trying to time the market? I'm fairly aggressive investor, but when the market started going south, I felt forced to shift the majority of the funds to an active fixed income category. When the markets begins to rebound, when I'd like to move back into the stock index fund, large company growth option, small company, you know, all of those things that are the diversified options we all should be in when we're accumulating assets. Good plan, bad plan. So I think this plays into what we were just talking about. What if the bottom was 20% ago or 15% ago? And we missed that already. And so, and it depends, I guess, at what point you got out, but if it was going down, the way that this market went down, I've never seen in my career. I mean, you have to go back to 87. And I started in this business, I think in 96 or 97. And so the shock to the system, to the markets that this impacted us, it was pretty violent. But I also want to say that what the government has done with the stimulus package is a shock to our system the other way. So that's why we believe once we can get to the other side of this, you do not want to miss those upsides. And so rebalancing, like in this situation, it's critical to rebalance back into what your appropriate risk level should be. So if you are, you know, 10 years out from retirement, you're an aggressive investor, like you're saying, then you should have that asset allocation to match that. Because essentially what you did here was to go to conservative, and guess what? Rates are at zero. The Fed is, the interest rates are at zero, which means for bonds, there is not a lot of opportunity. Fixed income is bonds. There's not a lot of opportunity in the next 5 years for there. So that is why it's critical to put yourself in a position for success for the future. No, and what I love about this too is if you're still employed and you're still making your contributions into your retirement plan and you have them going into these asset allocation classes, you're buying on sale right now. You are buying shares of companies that have been shocked by this. And it's not that the company has had poor performance, it's the global economy that has been shocked. So I would encourage you to get back, get allocated, and start, you know, buying in on those shares as the markets are low here. Any other feedback?
Yeah, I would just add one to that, which is usually when you start thinking about moving the money, the drop has already started. So you'd actually be realizing a loss, right, to get out of the aggressive investments and go to more conservative. And unless you need the money right away, there's some emergency that means that you need to cash out. My rule of thumb is let's never realize a loss unless we need to, right? Absolutely need to. So, and if the long term is 10%, as DJ was saying, that means it'll come back. And if you have a long enough time frame, like I say, 3, 5, 10 years before retirement, stay the course. Don't try to play the market. Most people lose.
Yeah, good. Okay, so I'm gonna, if anyone has questions out there that's listening, please feel free to put them into the Q&A, and we will, as we wrap up here, we will answer those as we go here. So I want to talk about what next steps. A lot of times in a situation like this, you feel like you need to take some sort of action. And I think a lot of investors out there that don't have advisors to work with, that's where they get in trouble, is they're taking those knee-jerk reactions and selling everything to cash, and then you can see the problems that we've just all talked about. So what are some opportunities you can take advantage of? Well, number one, I think that it would be wise to, if you have a mortgage, does it make sense to refinance right now? Call your local bank or call where your mortgage is at and see what the rates are, and if it makes sense for you. We of course would be happy to run the numbers if to see if that does what, if you want our opinion, if it makes sense, we can help you with that as well. Another thing is taxes are not, the extension to file taxes is now July 15th. It's also the deadline to add to your IRA and Roth IRA for 2019. So we absolutely think that this is an opportunity to buy things on sale. So if you haven't contributed to your IRA, please consider that. I would also encourage you to consider making a contribution if you can for 2020. So oftentimes we wait until the next year to make it for the previous year. But if you do that now, you will be buying low at these levels. Another thing to consider is if you have a non-retirement account, you can look at taking what capital losses. So if you've had a loss in your account, it may make sense to harvest that loss, which just means to realize it, and then you reinvest that the same day in another fund. And so you're just realizing the loss, you're staying invested, that's all there. But by doing that, that may help you with taxes in the future. And then the other thing that is a little bit more complicated, we'll probably talk about it on our upcoming webinar on retirement planning, but it's consider a Roth conversion. And the basic concept is that you shift money from a tax deferred or a traditional IRA or a 401k that you've never paid taxes on, and maybe you convert a little bit over to a Roth in a year or when the markets are down like this, because what will happen is it'll recover in a Roth IRA, which then will make all those earnings tax-free. Or if there's been a loss of income or your job changes in this environment, maybe you have lower income and you're able to pay those taxes at a lower rate. So those are pretty complex strategies. Please reach out to us. We are happy to help run those scenarios to see if that makes sense for you. And those are the kind of the opportunities that I would look to during these times. This is our process. So if you are not a client of ours, you most likely will come into contact with us through an educational encounter, much like this. And then the next step in that process is to really allow us to help you discover and learn more about you and learn more about your financial goals and situation. And we can come up with a tailored solution that's right for you. And then we not only give you the solution, but then our hope is that we take our clients on a guided journey, much like our clients are on with us today. We work with our clients in a guided way. We want to be their partner and help them through all of these times, especially these challenging times that we're in right now. So a little bit more about LPL Financial. They are, like Chandran said, the largest independent broker-dealer. They have SIPC. They are part of SIPC, which protects up to $500,000 in account protection, and then there's more beyond that. But what that protects is if LPL were to fail, your money is insured by SIPC. Now, it doesn't insure the ups and downs, but just the solvency of LPL. And all of our licenses are held there. And again, like Chandran mentioned, we have a lot of specialized services that we are here to offer. I don't want to go through all of these, but if any, you can look at our services on our website. If there's any help you need in those services, again, just reach out and we're happy to facilitate and help add value in that way. Okay, so lastly, I want to highlight our Facebook page. This is where we are able to give really timely updates. So we can go on live. Right now, we're actually doing it daily, talking about April is Financial Literacy Month. So we're doing little fun videos talking about all things finances. But it's also where we will give timely updates. So if you are not a fan, make sure to go there, like our page, and then also click the bell, because that will allow you to get notifications whenever we do videos and posts. And then lastly, we would love to get some feedback from you on this. So normally we would have intake or questionnaires for you to fill out, but we're kind of figuring this out on a virtual platform here. So if you have any feedback for us, please email that to financial.freedom@lpl.com. And also, if you have any more questions that we did not, that you didn't ask today, or maybe you're watching a replay of this, please feel free to send us questions at that email address. And then lastly, we are here, we are open for business, and we would love to offer you a complimentary consultation. If you are not our client, please reach out to us and we can schedule a virtual meeting with you today. If you are a client and would like to do a review with us, address any concerns that you have, talk about different opportunities that I discussed, please reach out to us and we will facilitate a time to get you with one of our wealth advisors as soon as possible. All right, any last thoughts? No?
We're here. We're here for you guys. It's tough, but we'll get through it.
Yeah. Okay, well, thank you everyone for attending. If we did not get to your question, we will address that either on our Facebook Live videos or on the next webinar. Thank you, everyone.
Thank you. Bye.
Bye.
See ya.